right, folks, we are going to go through a little info here. Going to go through a little fiscal policy. All right. This is something that's quick, but maybe you can think about it like this if you want. So you can drive cars fast, but you can't do it forever, right? So that would be like kind of like this is like a metaphor or analogy. That'd be like extremely low unemployment. If you drive too slow, right, you have high unemployment. Car can go faster. 70 miles an hour is sustainable. Some cars are just faster than others. Technology and productivity can help you. A little analogy, if that helps you. All right. Oh boy. All right. Let's keep it rolling. Here we go. So, how does the government stabilize the economy? Right? We talked about we're trying to get that business cycle to be flattened out and don't have as high highs and the low as lows. There's two things that the government can do. One is fiscal policy, which we're going to talk about today. And this is when Congress is like taking action. And the second is monetary policy, which is the Federal Reserve Bank trying to stabilize the economy. That's what my brother's going to come in and talk about. So we'll look at that in a couple weeks, but we're going to talk about fiscal policy today. All right, so we got two different types of spending, and maybe you've seen this in your gov class, but we got discretionary versus non-discretionary. Discretionary is when Congress is going to create a new bill uh, that is designed to change aggregate demand, okay, through government spending or taxation. Okay, so they can really kind of do two things, spend money or tax. Um, these things sometimes take a little bit of time, right? Especially these days. Congress is deadlocked a lot. It's hard for them to agree on anything. So like in a recession, Congress could increase spending to try to get us out of that bottom area and start us up back to an expansionary phase, right? Non-discretionary fiscal policy are automatic stabilizers, okay? These are permanent spending or tax laws that help counter the business cycle. So when GDP goes down, government spending automatically increases and taxes automatically fall. We're going to see how this works. I think unemployment tax is like a really great one to think about here. If the economy is doing really well, the government is not paying that many people unemployment, right? And we don't need to. But if we end up in that trough and a lot of people lose their jobs, more people are going to get unemployment payment. So the government's going to spend more money that's going to go into the economy and hopefully get us out of that recession sooner. Okay. And then we'll talk about income tax in a little bit. So there's two ways that they want to do this fiscal policy. Either they want to slow the economy down, right? And they would only really want to do that if there's high inflation. Um, and our government really doesn't do this ever anymore either, because we're always spending more money than we have. But um, we can spend less money that we don't have to try to reduce inflation. So sometimes they are going to cut spending to try to reel in inflation. Okay, decrease government spending, increase taxes, right? So they could use either of these two. And increasing taxes, yeah, is decreasing disposable income. So there's less money out there in the system. And so there's less money chasing fewer goods. So that should help with inflation too. So they could do those two things if they want to slow the economy down a little bit because it's just running too hot. Inflation's too high. This is kind of more where we're at in the 20th century. 21st century, come on now, 21st century. So expansionary fiscal policy, we're trying to reduce unemployment and increase GDP. So we're going to increase government spending, decrease taxes. When we decrease taxes, we give people more money to spend. That goes into the economy, et cetera, et cetera. All right. I don't think we need to do this. Let's skip ahead here. Hold on. All right. Let's see. Where can we go to next? Here we go. Oh, I should not do it that way. Oh, it's been a little while since I've done the Zoom. Sorry. Okay. So, timing and fiscal policy. Um, it can take time, right? That's one of the issues with it. You will see if there's like a really true recession that Congress will usually act pretty quickly. So like in 2008, 2009, like again, it took them a little while to realize there was an issue, but that was for everybody. And then they acted pretty quickly. Now, did they make the best decisions? That's another question, but they did do it. If it's really a major problem, they'll do it pretty quickly. But there's three time lags. Recognition lag, we just said this. A lot of economic indicators are looking backwards. They're looking at things that have already happened, and it's like, well, maybe the recession's already started, and people don't realize that. So it can, and this isn't just for Congress. This could just be for anybody. There's a recognition lag, administrative lag, and they got to make the bills. They got to agree on them. They got to go through the process of passing both houses, getting signed by the president. Like it takes a little time. And then operational lag. So then once that spending has been agreed on and that money in that bill is it's going to get sent out, um, it takes time to just organize all that and uh, get it all going. Now here it says changing taxing is quicker. True, but also like what time of year is it? If it's March, you're only to March 2026, we're going to change taxes for 2027 sometimes they do it in the middle of the year, but yeah, so those are your three types of lag. All right, so here you go. Here's an example of how long it can take, right, for a bill to get signed into law. And you can see that when they know it's important, they do speed up the process, but it still takes a while. Okay. It still takes a while. But yeah, it'd be interesting to look back at certain recessions and see what we get. All right, we're going to skip around again. And we're just trying to get through this in a orderly fashion. I keep doing that. It's not what I want to do. Here we go. Okay, so automatic stabilizers is the last topic here in Unit 3. And we already saw this, but let's talk a little bit more about it, right? So when we got our business cycle here, right, we're talking about income tax or transfer payments, right? When we're at some of these, when we start to go into this trough and we're ending our recessionary phase, government spending is going to kick in, right? Unemployment, welfare, other kinds of stuff. But also people are earning less money, so they should be paying less tax, right? So that should kind of ease the burden a little bit, maybe. It's a little hard to say. Um, but then when we get up at the peak, then those things are going to kick off, right? Now everybody's employed when we get to the peak, so there's going to be less unemployment. But it also is going to start breaking, right? People are making more money, they're going to pay more in tax, and we're going to decrease there. Okay. So taxes automatically decrease as we're heading down towards the trough. Um, and then they automatically increase as we head towards the peak. Yeah, so here's a little bit more on the income tax system. So when GDP is down, tax burden is lower. So that promotes consumption and increases aggregate demand. And then when GDP is up, there's more tax burden on consumers. So it discourages consumption and decreases aggregate demand. Okay, so that just kind of is a built-in automatic stabilizer. And then unemployment benefits are a really good one, I think, too, because it makes a lot of sense. Unemployment is higher, those benefits are going to kick in, more people are going to get money. And then when GDP is up, there's going to be less benefits paid out. So that's a really good example. All right, so here's some little graph with and without automatic stabilizers. So you can see how the darker line is with them. No, it's not. Huh. I don't know if that's a good graph then. All right, we'll move on. I think we're wrapping that up. Yeah. So we're gonna now go over to uh financial sector. So this is for our good old, what do you call it? Our first guest speaker. We're going to take a look at the financial sector here. We're just going to do a little bit. So this is financial assets. Hold on, I'm going to pause this for a second. You're good. I'm just filming a little thing for my kids. Are you filming? Filming it for my kids that when I'm gone so they can watch it. So it's going to take 5 more minutes. No, you're good. You're good. You can hear me talking about financial assets. So individuals and businesses and government borrow and save. So they need institutions to help, right? So this financial sector we're talking about a network of institutions. So these are like banks, mutual funds, pension funds, other financial intermediaries. And an asset is anything tangible or intangible that has value, right? So we can think of something tangible like real estate or gold. And then intangible might be like you own a stock. Even though that has some real meaning, it's just harder to imagine it physically. And then our interest rate is the amount a lender charges borrowers for borrowing the money. It's the price of a loan. And we've talked a little bit about that. It's just the cost of borrowing money is the interest rate. And then there are some assets that you can own that earn interest over time. So we're going to talk about bonds. Bonds actually pay you interest. And we'll look into that. All right. So some of you have taken personal finance, which is great. Learn about all this good stuff, how to manage all of it. We're going to just kind of talk more bigger picture. And investment in our class is always going to refer to business spending. So a couple things that people consider when they're looking at all this is market risk, right? So some things have more risk when you invest in them. And you just got to be careful. Stocks go up, stocks go down, you could lose money, right? There's also an inflation risk. Are you getting enough money back for your investment? Or is it just kind of losing value as it sits there? And then you got to be careful of companies like going out of business, right? So you can take out a bond on a company and they could fail and they could not pay it back. All right, so here's a way to see kind of a little graph here, and you can see there's potential as you go to the top of the pyramid for higher returns, so you can make more money on your investments, but you're also taking on more risk. So stuff at the very top here is futures. Those are super dangerous to play with. Same with options. You kind of really want to know what you're doing to do that stuff. And then kind of in the middle, right, we got stocks, real estate, which is a little bit more riskier than like mutual funds or index funds. And then bonds are pretty safe, but not always. And then at the bottom, right, we got like checking accounts, saving accounts. You're not going to make a lot of money there, but you're going to make something, but your money's going to be pretty safe. So it's a good little tool here to take a look at. And so then we got this term liquidity. So liquidity is the ease with which an asset can be converted to a medium of exchange. So if something's more liquid, it's easier to get it into dollars quicker so you can spend it. So like a checking account, you can just go to the bank and take money out of it. Whereas if you're options trading, it's going to be harder to sell that option. And it's going to be harder to sell real estate, right? So those are not as liquid as the stuff lower on the pyramid. All right, we got a little bit more and then we're done. So a bond is when somebody lends money to a government or a business, okay? And basically they're loans, but it's not like you taking out like a housing loan. It's like you're giving money to the business and they're going to pay you back. So it's, debt that government, businesses, or individuals will pay to the lender, and you get paid back in interest rate. So you don't have any ownership of the company when you do a bond. It's just a loan, and your payment is going to be an interest, right? So if I give a company $10,000, say it's like a 10-year bond, over that 10 years, they're going to give me an interest amount on that $10,000. And then when the bond is done, they're going to give me the $10,000 back. So if you want to get more money for your company, you could sell equity, okay? And that's a stock. So stock actually represents the ownership of a corporation. And the stockholder is entitled to a portion of the profit. Sometimes these are paid out in dividends, sometimes they're paid out other ways. But when you own a stock, you actually own a piece of the company, and you have voting rights, you should get paid profit, etc. Whereas a bond, you're just giving money to the company as a loan, and they're going to pay you back. So a bond is issued at a specific interest rate that doesn't change, right? So this is where you kind of have a little bit of inflation risk if you buy a bond that has a lower interest rate and then there's more inflation. So the US is the biggest seller of bonds. So a 30-year treasury, if it has a face value of $1,000, so you buy $1,000 bond, interest rate of 5%, you're going to get $50 each year for 30 years. All right. And then at the end, you're going to get that $1,000 back. Now, this is a good point. So let's say you bought your bond at 5% interest rate, but now the new bonds are selling at 3%. People want your bonds because they're selling at a higher rate. So you can actually sell the bonds before they mature, and you can make money on the bond itself because you have one that has a higher interest rate. They would rather have 5%. So, and it's, US treasuries are pretty safe. So yeah, these are inversely related. So bond price and interest rates are inversely related. Bonds are going to go up if interest rates are go down, and vice versa, right? Makes sense. If interest rates go up a bunch, the bonds that are out there currently are going to go down because the new bonds being issued will have a higher interest rate. Okay, so you're going to read this article. Your sub's going to hand you out this article, and you're going to look at stocks and bonds here. And read it and think about what's a riskier investment, stocks or bond. Try to think about why. And yeah, do a little research on this if you have time. And our guest speaker is going to talk about this next week. All right, folks. We'll see you later.